Yeah, good morning and welcome to today's webinar about transfer pricing for German subsidiaries in Denmark. My name is Nina Sur Poulsen and I'm Head of Members and Communications here in the Chamber of Commerce. And today I'm pleased that we have Ardit Nesimi from, Ardit is the Director for Transfer Pricing at the KPMG Aker Tax. And I'm pleased to have you with us today, Ardit. But before I hand over to you, I will shortly mention a few practical information. All of you, please be aware that the webinar will be recorded and you will get the recording afterwards together with Ardit's presentation. And during the webinar, you can ask questions in the chat and then we'll take them up during the webinar or at the end. And if you want to elaborate your question from the chat, or if you want to ask your question live, then please raise your hand, and then I will see to that you can also unmute yourself and ask the question directly to Ardit. But Ardit, welcome very much. I'm looking forward to it.
Thank you very much, Nina. Thank you everyone for signing up and participating in this webinar. As Nina said, my name is Ardit Nesimi. I'm a director at KPMG's transfer pricing practice in Copenhagen, in Denmark. Prior to joining KPMG as a director, I used to work in transfer pricing in Germany for around about 13 years with another Big Four, as we call, consulting companies. And in the last 3 to 4 years, I was the head of transfer pricing for a large German multinational. But somehow life brought me to the north side of the border. And I'm happy to assist many companies in their transfer pricing issues. In that regard, I also assist a lot of German companies because I actually have quite a lot of, as already mentioned, experience from Germany, so I can actually see transfer pricing issues and risks for German companies from both sides of the border, so to say. Nevertheless, this webinar will focus on the transfer pricing compliance in Denmark, especially in light of some new rules that have been enacted last year and that are in force for financial year starting 1st of January 2025, which means that they are relevant for all multinationals which operate in Denmark for financial year 2025 and onwards. I will quickly start my PowerPoint presentation, where we will go a bit deeper into these rules. The agenda for today's webinar is as follows. Firstly, I will just try to do a very high-level brush-up on transfer pricing compliance in Denmark and what that actually means. Then we'll go deeper about these new thresholds and what do they mean actually for companies, whether they actually also are obliged to be compliant or not. Then we'll look a bit more into how to basically prepare for transfer pricing documentation in 2025. And lastly, what are some of the trends and perspectives that we actually have observed in the market last year, but also this year in terms of what is really bothering both the tax authorities, but also the taxpayers.
Mm-hmm. And a short notice from me, would you please make the presentation in presenter? Now we see the whole the PowerPoint. So could you make it bigger? In presenter mode.
Does it work now?
No, it's still the whole PowerPoint program, and not only the yeah, exactly. Thank you.
So Denmark is actually one of the very first jurisdictions in Europe, maybe even in the world, which has enacted proactive submission regulations when it comes to transfer pricing documentation. What that means is that while in most jurisdictions, for example, as in Germany, transfer pricing documentation needs to be provided to tax authorities upon request or within the scope of a tax audit, in Denmark has gone a step further in terms of actually asking taxpayers to submit the transfer pricing documentation regardless whether there's a tax audit or not. So it's not upon request anymore. This was the case before 2021, but for financial year starting 2021 and onwards, all multinational companies had to submit a transfer pricing documentation 60 days after having submitted their tax returns. If the transfer pricing documentation is not submitted in time, the penalties are, I would say, rather high, which is 250,000 Danish krone, which corresponds to roughly 34,000 euro per financial year, which means that if you haven't done it for 2 years, you are up to roughly 70,000 euros. And if you actually submit it late, then this fee or this penalty is basically half, which is roughly 17,000. And while there are some other jurisdictions, for example, Latvia, which also has submission rules, Denmark is way more, let's say, strict in actually enforcing the penalty. So if you are not submitting your documentation, the penalties are levied, and the Danish tax authorities actually start that procedure quite fast, so they don't really forget also to issue penalties and so on. That's why it's actually rather important. What has happened is that while before every company which had a cross-border transaction had to submit documentation, regardless if the transaction was even 1,000 euro, whether it was a cost recharge because there was someone from Germany coming to Denmark and the Danish company paid a hotel, you still had to submit a transfer pricing documentation. So many companies actually were not aware that even they had to submit a documentation because the transactions were quite low. There were many private equity companies which had some sort of investment in Denmark with very small management fees, who suddenly found themselves receiving a letter from the Danish tax authorities because they had not submitted, so they were quite ignorant about the rules. The Danish state basically took this message and tried to, let's say, ease the administrative burden for many companies, so that smaller transactions actually don't really have to be documented, and that would make many companies fall outside the new rules, which means that you don't anymore have to submit a transfer pricing documentation in Denmark proactively. So I'll just go briefly through what are these thresholds and how they would apply to companies. So there have been changes to the Tax Control Act, paragraph 39 and paragraph 40. For German companies, the Danish Tax Control Act is the same as the Abgabeordnung, the German fiscal code. which sets basically the legal background about audits and so forth. So the changes to the Tax Control Act, which are enacted for financial year 2025 and onwards, are already in force, and they govern who should actually be required to submit a documentation, what actually should be documented, and when should this be documented. As I already said, the purpose of these changes is to reduce the administrative burden, especially for small and medium-sized entities. It would remove some low-risk entities and transactions, in the sense that the tax authorities do not need to spend time to look at smaller companies where the risk of tax evasion and so on is much lower. And it would enable the Danish tax authorities to focus their resources and efforts on bigger entities, bigger transactions, and more risky transactions. As already mentioned, this is applicable for financial years 2025 and onwards. And given that you need to submit a transfer pricing documentation 60 days after submitting the tax return, which for most companies is end of June, you would have to submit the TP documentation for 2025 towards the end of August of this year. So these rules are actually quite relevant and very actual for all companies. So what are actually the changes? Probably for most of the German companies, these numbers are relatively small because they are not on group level. So for bigger German companies, I think these are very cosmetic changes, because the balance sheet sum has been increased. Before, it used to be 17 million euros. Now we are at 26 million euros. The turnover criteria has increased from 34 million euros to 52 million euros, and the number of employees has basically stayed the same. Just as a refresh, what that means is that if a group company has more than 250 employees, it would be required to submit a transfer pricing documentation. If the number of employees is lower than 250, then the other two criteria combined need to be fulfilled for a company to be obliged to submit a transfer pricing documentation. As I said, given that these are thresholds which are applicable on group level, I would say what is considered a Mittelstand in Germany would probably be above these rules quite easily. Yeah. So in Germany, I think you need to submit a master file if you are above 100 million euros on a local level, not on a group level. So if you compare that with the Danish rules, then the difference is actually quite big. So from that perspective, I don't see that this would affect many companies in this sense, because the increase of the balance sheet and the turnover is not really substantial. And the number of employees, which is, I would say, the key determinant, is staying the same. Nevertheless, there have been, for the first time, also changes in the transactional thresholds, which has not been the case before. And this is, for many companies, actually a game changer. So if the rules which I showed in the previous slide, if they are fulfilled, and in principle you would need to submit a transfer pricing documentation, then we go into looking at the actual transactional volumes. And there could actually be changes for especially small companies. So if the aggregate transactional amount is under 5 million Danish krone, which is roughly somewhere between 650 and 700,000 euro in one financial year, and the intercompany receivables and payables are under 70 million Danish krone, which is somewhere between 6.5 and 7 million euro, then there is no obligation to submit a TP documentation. So very big or medium-sized German companies which have transactions, so they are very big from a group perspective. However, the Danish business is relatively small, which would mean under 5 million Danish krone transactional amounts, then there is no obligation to submit the transfer pricing documentation anymore. If there's a permanent establishment, let's say in Denmark, where there's one salesperson or one construction engineer and so forth, and this is below 5 million Danish krone, which typically would be the case, then there is no obligation anymore to prepare a transfer pricing documentation. An important remark is that there is these thresholds are very objective. They are not looking at the actual risks. Arm's length principle obviously is still in place. The OECD transfer pricing guidelines continue to be applicable. And one thing to remember is that these thresholds are actually on aggregate transactional basis. So there is no possibility to do a netting in the sense that there is an income coming to Denmark and then there is a cost going out of Denmark, and you basically net the two and you are under the 5 million. This is now how it would work. It would actually take the income transaction plus the cost transaction, even though the cost is minus, let's say, for the Danish entity. It would not work in the sense of netting them, but rather look at both numbers, whether they would result in more than 5 million. There's one more significant exception, which makes also the interpretation of the law a bit more tricky, and that is that transactions which concern intangible properties, intangible assets, and so forth, they are actually not part of the rules, which means that if there is an intangible transaction, such as a royalty transaction, a brand transaction, an R&D transaction, and so on, those must be documented regardless of how big they are. So even if there's a transaction of a brand payment, let's say, which is 10,000 euro, significantly lower than the transactional threshold of 5 million, that would need to be documented. If there are transactions between the Danish company and any non-EU with which Denmark has no tax treaty, that also needs to be documented. For all those participants who are not based in Denmark, I just want to say that Denmark doesn't have a very extensive tax treaty as Germany does. So it's quite easy to actually fall under the exceptions, in the sense that there could very easily be a transaction with a country with which Denmark has no double tax. And domestic transactions still need to be documented in Denmark. However, now we have an exception. So before, you also had to document all domestic transactions. The rules now have changed a bit, where they don't need to be documented as long as those transactions are with the same tax regime. if there's a domestic transaction where a different tax rate applies, that transaction also needs to be documented, even though it is within Denmark only. Then, especially when it comes to intangible property, as I said, the rules are not clearly defined. So we have here a very typical case where we have a principal company. Let's say that's a German headquarters, which sells products to a Danish company, which is a limited risk distributor, which then sells those products to a customer. It receives the payment, the Danish company, as the invoicing party, and that LRD then gets remunerated on a target, let's say, operating margin level, with the residual going back to the German headquarters. Is question whether basically that, even though it is not an IP transaction, because it's a goods transaction. However, as we know, with the principal structure, IP is quite often embedded within the price of the goods. So it's a question whether that requires a documentation obligation, considering that there is some IP embedded within the goods. So we really advise companies to actually look into these kind of structures, even though there is not a specific IP related transaction. The transfer pricing documentation in Denmark, but I guess around the world, also has seen a lot of changes throughout the years. Started very early with the first OECD transfer pricing guidelines, chapter 5, which required companies to document intercompany transactions. There was a big change in 2010 with comparability analysis and the introduction of the profit-based methods, with the TNMM being one of those which is probably the most in use at the moment, which then brought us to 2015, where there was a complete overhaul of international taxation, and transfer pricing documentation was a big part of it, where a three-tiered approach, master file, local file, and CBCR reporting were introduced. This brought, again, a revision of the transfer pricing guidelines in 2017. In Denmark, as I already said, one of the first countries to introduce proactive submission requirements. Again, another change of the transfer pricing guidelines with a new chapter on financial transactions and hard-to-value intangibles. And finally, in 2025, we have Amount B report, which focuses on sales and marketing activities. That was also published. We do not know, especially also with the introduction of AI, how transfer pricing tools with respect to documentation will evolve. However, probably we will see submission requirements being introduced in many countries, especially within the EU in the coming years. I think since 2021, Portugal has also introduced documentation submission requirements. Belgium has also introduced that, and it very well might be that Germany will follow this path again. And what we see is, especially because of tax audits, which then can also lead to court cases, what is stated in the transfer pricing documentation, and actually having a very good transfer pricing documentation, is of utmost importance. In general, I have not really seen a transfer pricing court case that somehow has not touched upon the subject of transfer pricing documentation, which then brings to the importance of really having a transfer pricing documentation in place, and not only a transfer pricing documentation that meets the content requirements of the OECD Chapter 5, but rather also what is actually stated in the transfer pricing documentation. Which brings me to the point, is it really sufficient only to meet these minimum requirements? The Danish transfer pricing documentation requirements are aligned to the OECD requirements, and as such, they are quite similar to the German requirements. There are certain differences. However, in general, if you would prepare a transfer pricing documentation that meets the German requirements, in general, I would say that also fulfills the Danish minimum requirements. The question is that enough, basically? Yeah. So in Denmark, we have three, I would say, cumulative conditions. One is following the thresholds, which I briefly talked about, so paragraph 39 and 40. Then Denmark also has something similar to the GALFs in Germany, where you have a list of requirements with respect to content that actually needs to be part of the documentation. And finally is the 60 days deadline after having submitted the tax return. However, once you have submitted that in Denmark, you cannot go back and change things. And that's really important into what you actually put into the documentation. In many other countries where you are requested to provide the transfer pricing documentation within 30 days or 60 days after you have received a letter from the tax authorities, you might even start then actually to prepare the transfer pricing documentation. Or you might opt to review that transfer pricing documentation in light of the audit and try basically to improve it and so on, and take a position with respect to the audit. In Denmark, only because you have to submit it, you cannot go back and make any changes because it's submitted electronically and the tax authorities have access to it right away in case they want to initiate an audit. So there are certain cases we have already seen in Denmark, which have gone to court regarding a transfer pricing documentation which is not sufficient. I have picked a few cases here from 2021 in general to 2025. In general, there is some findings that the comparability analysis was very much flawed or didn't have any comparability analysis. And once you have a transaction that you are documenting in Denmark, again, regardless how big that transaction is, you must have a comparability analysis. If you do not have a comparability analysis, then the tax authorities and the courts might find that documentation not to be sufficient. Not having a sufficient documentation is the same as not having submitted the documentation. So you still have to pay the penalty of 250,000 Danish krona, or roughly 34,000 euros. This is one of the main findings that we have seen pretty much in all cases. In Scanmill's case, there was no organizational description. Transactions were not described in detail, which is the same pretty much as the Mogas case, where the transaction seemed not to be described properly in the documentation, or the selection of the method is not correct, which brings to a flawed comparability analysis, or no clear choice of transfer pricing method, and so on. So only by checking the minimum requirements, whether they were fulfilled or not, in some sort of a checklist kind of exercise, that doesn't mean that your documentation is actually very good. It can save you to receive a penalty in the first case. So there is no penalty only because you submitted the documentation in time. But if you are picked for an audit, these kind of flaws can actually become evident. And if you decide then to pursue any kind of litigation process against the Danish tax authorities, then there is no possibility to change the transfer pricing documentation, and you might still end up paying a penalty on top of having your income adjusted. So what are some of the key considerations when preparing the TP documentation? Data, obviously, is something that probably we hear about every day. That is very important to collect the right data, and I'll jump here directly to number 5, actually, that this data that you put into the transfer pricing documentation in Denmark, that somehow need to be the same data that you put in the tax return, that you put in annual report, and that you put in your CBCR reporting. Because all this information is submitted to the Danish tax authorities, who can decide to do a reconciliation of all these data sources and to check whether the information you have put in all these filings that you have performed, whether those data is uniformly correct along all the data sources. So having the data validated and having the data reconciled throughout your reporting obligation, that's very important. Next is what you put in terms of content for the function, assets, and risk analysis. Is there any substance to that? And the conclusions you have made, the statements you are taking, and thereby also the position you are taking within the transfer pricing documentation. Can you actually back that up with proofs that what you are stating there is in reality also the case? If you are stating that my Danish entity is only a limited risk distributor, if there is a tax audit, can you really back this up? This is also quite important. So it's important to pay attention how you actually phrase things within the transfer pricing documentation, which means that when you have prepared the transfer pricing documentation, have you gathered the right evidence to support these claims that you are making in the documentation? And sometimes it's okay not to have all the evidence up front, obviously. However, one needs to be prepared that if you get picked up for an audit, that you can actually produce that kind of evidence, and that it will not be very time consuming to produce that evidence, especially because sometimes you have to go obviously back in time. So having the preparedness, I would say, of the organization to produce that evidence is very important. Have you updated your comparability analysis, benchmark analysis that were prepared in 2022 and that go back to 21, 2020? Have you actually refreshed that? That's also quite important. So making financial updates of previously prepared benchmark analysis is something which is very much recommended, especially because in a tax audit, that is probably the first thing the tax authorities are going to look at. Typically, the benchmark analysis formed the basis of your argumentation, whether your profit margin was correct or not. tax authorities will definitely try to attack whether your benchmark was done correctly or not, because that is what you are using to substantiate your claims about your profit margin. So being prepared in terms of the comparability analysis is of great importance. Number 5, as I already stated, it's important to reconcile the data with especially the tax return. And last but not least, because of the submission requirements, the Danish tax authorities actually have the access to your documentation. So they can go in the tax portal, download your transfer pricing documentation, and be quite well prepared before you know it, before you actually get picked for an audit. They can be prepared, ask questions before you have even heard them. So this is very important in terms of really producing documentation that not only meets the minimum requirements, but rather is very robust and solid and can actually take any questions raised by the Danish tax authorities. So what is actually happening with the penalties? I just wanted to bring some of the experience we have seen so far. If you are supposed to submit your transfer pricing documentation by Monday at 9 o'clock, as it was last year, if you submit it at 9:03 or 9:11, this is already considered that you have submitted late and you have to pay a minimum. So timing is really important and should not be taken very lightly. Because of how the submission requirements work and because it needs to be uploaded electronically, it is not like in the old days where you can ask the tax authorities for, can I submit it tomorrow? The Fristverlängerung, as we say in German, doesn't work. So you have to be very, very careful in actually meeting the deadline to the last minute. The Danish tax authorities, when they decide to issue a fine because you have submitted late or you have not submitted, they do not consider whether the criteria are actually met or not. They will just send you a letter. Taxpayers many times do not follow up, but rather they pay the fine. And that is not because they necessarily agree, but sometimes because the way how it works is that if you decide not to pay a fine and so forth, this becomes a case that gets referred to the police. And then you have another procedure, basically, that needs to be followed. And that procedure means more costs for taxpayers. So many companies, even though they feel like they are not supposed to pay a fine, they just pay it because there is so much uncertainty involved, and there's another procedure involved if they don't do that. It is hence very recommendable to get an assessment before, if you receive a letter from the Danish tax authorities, to discuss this matter. If you feel that you have a case, instead of just paying the fine, you can decide actually how to proceed in terms of certain next steps. And obviously there are many companies who also take another route instead of just paying the fine. However, performing an assessment is actually recommendable before doing it. And we at KPMG are lucky to actually have the person who was heading the penalty department for transfer pricing now with us in the firm. And she assists many companies successfully in terms of the penalties, and we have seen many cases where the penalties have been annulled. What are some of the trends that we have observed in the last year working in different kind of cases with the Danish tax authorities? I think probably this could sound very interesting for many German companies. So there is a focus with the Danish tax authorities to reduce processing times in the audit department, which is definitely a very good news for many companies that are undergoing an audit. However, what we do see is that those audits that we see, they are very much in depth. There is much more extensive request for documentation. They ask for more transparency, and there is an increased focus on comparability analysis and how the comparables have been selected. One of the reasons for this is because we have seen in the last few years the Danish tax authorities lose quite a few cases in the National Tax Tribunal or even the Supreme Court, and that has made them take another approach in terms of audits, and I've personally seen quite some focus on comparability analysis, where the tax authorities have asked way more questions how the companies were selected, even saying that these are not perfect comparables, even using this word perfect comparables. So they are becoming way more rigorous in terms of asking questions about comparability analysis. In general, though, especially when it comes to Germany, we see that once companies have a double tax issue, the Danish tax authorities are very open to conflict resolution. They are perceived to be very cooperative, and I think Germany is the #1 country with which Denmark has mutual agreement procedures in place, and the German and the Danish tax authorities are actually cooperating quite well in resolving in an efficient manner all double tax issues, which is obviously very good news for German and Danish taxpayers. There are certain focus on specific transactions, obviously financial transactions, which I think that's also the case in Germany, is one of those transactions that's always in focus, and that will probably be for a very long time. They also look a lot at IP transactions. As I already stated, the new rules, for example, they exempt IP transactions. They still need to be documented. That's a very clear focus. That royalty transactions and Dempe and so forth are always quite a lot in the focus of the Danish tax authorities. And last but not least, also because of what has been happening in the US with the different tariffs, the link between transfer pricing and customs has also been in the focus of the Danish tax authorities. Obviously, that is not the case for transactions between Denmark and Germany because we are in the European Union. But if you are a taxpayer that has a Danish entity and trading with someone which is outside the European Union, you have to pay attention how the customs implications are to transfer pricing. And what do we see actually from the taxpayers? We see many companies trying to get tax certainty through concluding bilateral advanced pricing agreements, especially also with the US, because of the tariffs and what's happening in the US in general. Many companies try to get their transfer pricing settled through an advanced pricing. We do see quite a lot, as I would assume many countries in the world, artificial intelligence as a disruptor in the supply chain. What are actually the transfer pricing implications of dealing with that? And last but not least, global mobility and the tax implications of that. So people working in different parts of, especially, let's say, very relevant for Danish companies if people work from Germany or somewhere else within the European Union, and what are basically the tax and transfer pricing implications of that. That basically concludes my presentation for today. You are obviously very welcome to ask any questions here within the webinar. I think we have around 20 minutes left, but obviously you are also very welcome to contact me directly or one of my colleagues. Obviously, I will be, as Nina said at the beginning of the webinar, we will be sharing the slides with you after the webinar, and we will be also uploading the webinar on the website of the German-Danish Chamber of Commerce. But I would welcome any questions you might have now. And also, you are more than welcome also to share any kind of experiences you have had with Danish transfer pricing documentation. Since I would assume most of you, if not all of you, already have had to submit a transfer pricing documentation. Thank you very much for your attention and for joining this webinar.
Thank you, Ardit. That was a lot of different information about transfer pricing and also for German companies here in Denmark. So thank you very much for that. We haven't had any questions, and I see perhaps two reasons. First of all, the topic is a complex topic, but also it could be that you have answered the questions the participants would have had during your presentation. But at least if you have any questions, then please ask them now. Ardit, you have taken us through a lot of different things about the new regulation in Denmark with transfer pricing, and you have also pointed out that Denmark is very strict in this matter, and that you should be aware of big penalties if this transfer pricing documentation isn't sufficient. And also you have underlined that the preparation of this transfer pricing documentation is very essential, and also the wording, which I found was also an interesting point. And then also thank you for sharing your insights from KPMG and your learnings from your work with your clients. That was also very insightful. But there hasn't been any questions, but I think you have taken us through a lot of things, and if you have any questions, as Ardit said, then you can also take up the contact directly with Ardit. But thank you very much to you, Ardit, for presenting us this important topic, and also for everyone who has been with us today. Thank you for joining the webinar, and as Ardit also said, you will get the recording and also the presentation here afterwards. But thank you very much.
thank you as well
Yeah.
for providing the platform and organizing this webinar.
Yeah.
Always a pleasure.
Yeah. Thank you very much, and everyone has a very nice day today. Yeah.
Thank you.
Yeah. Bye-bye.
Bye.